Tired of trading your precious time for money? What if you could generate income even while you sleep? In this video, we're diving deep into the world of dividend investing. We'll explore what it is, why it works, and the key terms you need to know. You'll also learn a step-by-step plan to get started so you can begin building your own passive income stream. Stick around until the end to avoid common beginner mistakes that could cost you money. Dividend investing is simply investing in the stocks of companies that pay dividends. These companies share a portion of their profits with their shareholders. These payments are typically made quarterly, but some companies pay monthly or even annually. The cash is paid directly into your brokerage account. This allows you to generate income without actively trading stocks. You receive payments regardless of the stock price fluctuations. You can then reinvest those dividends to buy even more shares of the company. This can lead to compounding returns, or you can use the income to cover your expenses. Dividends provide a tangible return on your investment, especially during market downturns. This income can act as a cushion, helping you weather short-term market volatility. This can also provide a psychological benefit, helping you stay invested during tough times. Dividend-paying companies are often well-established and financially stable. These companies have a proven track record of profitability. This makes them potentially less risky than growth stocks. Dividend reinvestment supercharges your returns through the power of compounding. Reinvested dividends buy more shares, which in turn generate even more dividends. This creates a snowball effect, accelerating your wealth accumulation. Let's cover some essential dividend terms you need to know. First up is dividend yield. Dividend yield is the annual dividend per share divided by the stock price. It shows the expected return on your investment based on the current stock price. For example, if a company pays a $2 annual dividend and its stock price is $50, the dividend yield is 4%. Next, we have the payout ratio. The payout ratio is the percentage of a company's earnings that it pays out as dividends. A lower payout ratio, say 30–50%, indicates that the company has room for dividend increases and is in good financial health. A higher payout ratio, like 80% or more, may be unsustainable. Now let's talk about Dividend Aristocrats. Dividend Aristocrats are S&P 500 companies that have increased their dividend payments for at least 25 consecutive years. This makes them highly reliable dividend payers. The ex-dividend date is the date you must own the stock to be eligible to receive the next dividend payment. If you buy the stock on or after this date, you won't receive the upcoming dividend. Finally, dividend growth is the rate at which a company increases its dividend payments over time. Consistent dividend increases make companies attractive investments. Ready to get started with dividend investing? Here's a step-by-step plan. First, you'll need to open a brokerage account. Choose a reputable online brokerage that offers commission-free trading. Examples include Fidelity, Charles Schwab, and Vanguard. Next, you'll need to research dividend stocks. Use financial websites like Yahoo Finance, Google Finance, or Morningstar. Look for companies with a solid dividend payment history, a reasonable payout ratio, and a sustainable business model. Consider starting with Dividend Aristocrats as a good starting point. Then determine how much you want to invest. Decide on an amount you're comfortable with. Start small and increase your investment as you become more comfortable. Now it's time to buy dividend stocks. Place your order to buy the stocks you've chosen. Consider using a dividend reinvestment plan, or DRIP. This automatically reinvests your dividends to buy more shares. This is a powerful way to compound your returns over time. Finally, monitor your portfolio regularly. Review your portfolio's performance and rebalance periodically to maintain your desired asset allocation. Let's talk about some common beginner mistakes to avoid. First, don't chase high yields. While a high yield might seem attractive, it can indicate financial trouble for the company. Always research the company's financial health and dividend sustainability. Next, don't ignore diversification. Don't put all your eggs in one basket. Diversify your investments across different sectors and industries to reduce risk. Also, don't try to time the market. Focus on the long term and hold your dividend-paying stocks through market ups and downs. Be mindful of brokerage account fees. Choose a brokerage with low or no trading fees to minimize your costs. Finally, don't forget to reinvest your dividends. Failing to reinvest is a missed opportunity to compound your returns and accelerate your wealth growth. Now you have a solid understanding of dividend investing and how to get started. Remember that building passive income takes time and patience. If you're ready to start your journey to passive income, comment "I'm ready for passive income" below. If you found this video helpful, please like it, subscribe to the channel, and hit the notification bell so you don't miss future videos. Thanks for watching, and happy investing!